The transition of Wall Street from a place of cigars, shouting, and gut instinct to a silent world of silicon and high-frequency algorithms is perhaps the most radical transformation in the history of global capitalism. To understand the world of 2026, we have to travel back to an era where the idea of a computer trading a stock was considered science fiction. In the mid-20th century, Wall Street was a physical battlefield. If you wanted to make a fortune, you needed a loud voice, a fast pair of legs, and a feel for the tape. It was an ecosystem built on human psychology, where the smart money was often just the person with the best inside information or the strongest stomach for risk. But while the titans of the 1960s were busy yelling over one another in the pits of the New York Stock Exchange, a different revolution was brewing in the quiet hallways of academia. The quants, short for quantitative analysts, didn't care about corporate gossip or the charisma of a CEO. They cared about the numbers. The catalyst for this shift can be traced back to a brilliant math professor named Edward Thorp. Thorp was the ultimate outsider. He didn't start by looking at the stock market. He started by looking at Las Vegas, armed with an early IBM computer and a deep understanding of probability. Thorp proved that the game of blackjack wasn't just a game of luck. It was a mathematical puzzle that could be solved. By inventing the first wearable computer to predict roulette outcomes and perfecting the art of card counting, Thorp realized that if he could find an edge in a casino, he could find an even bigger one on Wall Street. When he published Beat the Market in 1967, the financial establishment laughed. They believed the market was a random walk, a chaotic system that no human, and certainly no machine, could predict. But Thorp proved them wrong by using delta hedging and statistical arbitrage to extract consistent profits while everyone else was gambling on hunches. This was the crack in the dam. The 1970s brought the hammer down with the arrival of the Black-Scholes Model. In 1973, Fisher Black, Myron Scholes, and Robert Merton published a paper that provided a mathematical formula for pricing options. Before this, buying an option was like betting on the weather. Afterward, it was like engineering a bridge. The formula allowed traders to calculate the fair value of an investment based on volatility, time, and interest rates. It effectively took the guesswork out of risk. Suddenly, banks weren't just hiring MBA graduates from Ivy League schools. They were scouring the physics and mathematics departments of MIT and Caltech. These rocket scientists, as they were mockingly called by the old guard, brought with them a new language of stochastic calculus and partial differential equations. They viewed the stock market not as a collection of companies, but as a giant, vibrating grid of data points. This era saw the birth of the first truly digital trading desks. As computing power became cheaper and more accessible, the quants began to build black boxes, proprietary algorithms that could spot tiny price discrepancies between related stocks, while a human trader might take minutes to notice that a stock in London was trading slightly cheaper than its counterpart in New York. A computer could spot it, trade it, and profit from it in seconds. This led to the rise of legendary firms like Renaissance Technologies, founded by Jim Simons. Simons, a world-class codebreaker and mathematician, did something unheard of. He refused to hire anyone with a background in finance. He wanted astronomers, physicists, and cryptographers. His Medallion Fund would go on to become the most successful hedge fund in history, generating average annual returns of over 60% for decades. The secret wasn't better intuition. It was better math and the cold, unfeeling execution of code. By the 1980s and 90s, the rise of the quants was no longer a secret. It was an arms race. The introduction of the Bloomberg terminal in 1982 provided every trader with a massive fire hose of real-time data. But only the quants knew how to build the filters to find the gold within that data. However, this shift toward total mathematization brought new systemic risks. The 1987 Black Monday crash was a chilling preview of what happens when algorithms go wrong. For the first time, program trading was blamed for a massive market collapse. As computers automatically sold stocks as prices fell, creating a feedback loop of destruction that the human mind couldn't stop. It was a lesson the world would forget and relearn many times over. As we entered the 2000s, the battle moved from the what to the when. It was no longer enough to have the best algorithm. You needed the fastest connection. This gave birth to high-frequency trading. Firms began spending billions of dollars to lay dedicated fiber optic cables through mountains and under oceans, just to shave a few microseconds, not milliseconds, but microseconds, off their trade times. In this new world, the physical location of your server relative to the exchange's server became the most important factor in your profitability. By the 2010s, the pit trader was an endangered species. The chaotic, colorful floor of the New York Stock Exchange became more of a television set for news reporters than a place where actual price discovery happened. The real action had moved to massive, unmarked data centers in New Jersey and Chicago, where thousands of liquid-cooled servers hummed in the dark, executing millions of trades per hour without a single human finger touching a keyboard. This brings us to the present day and the threshold of 2026. We are now witnessing the next evolution of the quant, artificial intelligence, and machine learning. Traditional quant models were still designed by humans. The math was hard-coded by a physicist. But today's AI models are blacker than ever. They are capable of deep learning, meaning the machine looks at decades of historical data and discovers patterns that are invisible to the human eye. These AI quants don't just look at stock prices. They analyze satellite imagery of parking lots to predict retail sales. They scan millions of social media posts to gauge sentiment, and they monitor global shipping lanes in real time. We have moved from computing Wall Street to automating reality. The risk, of course, is that as we hand the keys of the global economy over to these hyper-complex machines, we lose our ability to understand why the market is doing what it's doing. The flash crash events of the last decade show that when machines talk only to other machines, the speed of a collapse can outpace the speed of human thought. Yet, there is no going back. The genie is out of the bottle. The quants have won. They have turned the stock market into the world's largest, most complex video game one, where the stakes are the very survival of the global financial system. As we look toward the future of 2026 and beyond, the question is no longer whether humans can beat the machines, but whether we can build machines that are stable enough to keep the world running. This is the legacy of the mathematicians who dared to walk onto Wall Street with nothing but a calculator and a dream of perfection. They didn't just find the code to the market. They rewrote the code of the world. Money and power are no longer just about who has the most gold or the most land. They are about who has the most processing power and the most elegant equation. The era of the gut is over. The era of the quant is absolute.